So let's start talking about trading triangle chart patterns like a champ. Now, chart patterns are well documented in technical analysis literature and occur based on the psychological phenomena that occur between buyers and sellers of financial instruments in liquid markets. Now, cryptocurrency, since it's not really tied to any fundamental data, it's not tied to any economy, it lends itself perfectly to technical analysis. And basically, we can call technical analysis anything and everything we do on charts, or you can call it chart analysis. And therefore, understanding what a price chart is trying to tell you and seeing opportunities in a price chart can be very important. Now, I am sure you've heard about chart patterns for online trading and their relationship to technical analysis. You probably know about double tops and triple tops, head and shoulders, and rectangles. So in order to have a complete understanding of chart pattern trading, we should also gain a good understanding of one of the most common on-chart formations. In fact, it's the only one that I trade. And what I'm referring to is triangle chart patterns. So in this webinar, we're going to discuss the basic formation and some ways to properly identify and trade these patterns. The triangle pattern is a specific figure formed on a price chart, typically identified when the tops and the bottoms of price action are moving towards each other. Now, there are different types of triangles. When the upper and the lower level of a triangle interact, traders expect an eventual breakout of that triangle. As such, many breakout traders use triangle formations for identifying breakout entry points, exit points, stop loss placement, as well as targets. So let's go over to a live chart for a second. And on this chart, which I call market structure, it shows you most of the most common chart pattern formations. And we start on the left here with double bottom, bull flag, bull pennant, descending wedge, triple top, bear flag, bear pennant, inverted head and shoulders, expanding wedge, cup and handle, and head and shoulders again. Now, we have this pattern. We have that pattern. We have this pattern. This one. This one. Now, I call all of these, no matter what the pundits in the market want to call them, what the gurus out there want to call them, I call them simply triangles. Okay, some want to differentiate wedges and all these other finite names, and they want to call some ascending triangles, descending triangles, symmetrical triangles, and they want to give bias or character to specific patterns. Well, you see when we get to the end of this class that I've tested over 700 patterns for bias. That means when you see this particular triangle forming, it's going to tell you it's a bearish continuation pattern. To me, it's a bunch of hogwash. Statistically, when I've checked it out, it's not a big enough percentage one way or the other for me to bet my money on it. Okay. Now, the fact is triangles are extremely reliable. If you get away from the characteristic and the bias and say, okay, I'm going to lump these all into triangles, and when these several things occur, then it's going to give me a trading decision. Because even though you might have a symmetrical triangle with a breakout and a bullish characteristic, if it does, the only way that the asset's going to move is the direction of the breakout. So until it breaks out and gives me a breakout, I don't care. I don't want to get myself preset into what I'm expecting. I want to trade what is happening. So I lumped everything into triangles. Now, the biggest and most well-known triangle, and you should know the terms, okay? And this is called, what you see on your chart, is a symmetrical triangle. what happens is you have a support and resistance lines moving in the same degree. So therefore, they're going to converge and form an apex. So what we see is this is the same degree as this. This is the apex. This is the base of the triangle. Not here, but here. Because you see, this is where you have to take it. This is where the upper line of the triangle began. Because it didn't start out up here. So you can only measure the base of the width from the point in which the triangle started. And you'll see it. Well, it's not back here. It would be here. So it's this line and this line are the width of the base of the triangle. And this becomes very important. I'll show you two in more detail in a minute. But so we have the apex, we have the upper line and the lower line. Now, I'm not going to get into whether there's support and resistance lines because they're unimportant. Because basically when price is pushing up, this is a resistance line. When price is falling down, this is a support line. But they're really just the lines of the triangle in this case. Now, when price breaks out, and we don't know, because of what we're looking at, whether price is going to break upward or downward. But we know that the breakout, if it's a true breakout, will have the momentum to carry it to the width of the base of the triangle, which can be used as our target point, because we have to have a target point to set our risk management and our risk assessment. So typically with a triangle pattern, the expected directional breakout is unknown. Please keep that in mind. Please stop saying, oh, when I have an asymmetrical triangle, should be a bullish breakout. Please stay, the directional breakout is unknown. For this reason, that it is a bullish or bearish move at equal strength as seen through the price action. When a breakout eventually occurs, it is likely to provoke a price move equal to the size of the pattern. Therefore, you should carefully identify a potential breakout in the upper and the lower level of the triangle in order to take the right position in the market. So ascending and descending triangles, as opposed to symmetrical triangles, are done exactly the same. That's why I call them all triangles. The difference is in an ascending and descending triangle, you have one level that's horizontal while the other is moving in a, excuse me, while the other is moving on an angle. So in a downtrend, you would have a horizontal line at the bottom and an angle line on the top. In an uptrend, you'd have it just reversed. But ultimately, they are triangles. You have your breakout of the triangle, you have the width of the base, and you have your apex. And until it breaks out, you have no idea what it's going to do. So the key here is finding the breakout, verifying the breakout, and understanding when to trade in the breakout. Then we also have pennants. Pennants are true symmetrical triangles. Pennants on a chart have a similar shape to that of a symmetrical triangle. They typically appear during trends and have a trend continuation character. Throw that out. They typically appear during trends and could maybe possibly now and then have a trend continuation character. A bullish pennant is similar to a symmetrical triangle in appearance. You set your targets the same. Okay. There's all types of weird formulas that people do, And they'll tell you all about, you hear people talking about pennants and flags all the time. Well, if they were so successful in doing all this, they'd all be trading, making tons of money, and they're not. Okay. So all these big gurus out there with these big formulations for what to do and what's a continuation and what's a, okay, forget it. You want to filter out all of your trades to only come to high probability trades. So we simply lump all the triangles in there, throw all that characteristic and trend continuation and reversal patterns out the window. And we say, when we see a triangle developing, we're going to have a set of rules to follow to see if it's a real breakout and decide whether I'm going to trade that breakout. So now we can come to the rules. Once you've got a triangle formation, we can use the width of the triangle, the base, to set our target. But to be honest with you, it's kind of hard to set our target until we have a breakout. So we don't know if it's going to break up or down, and we don't know at what point, while it's moving into this apex, is it going to break out? Because our target point will be different if it broke out here than if it broke out here, because we're going to set this distance from the breakout. So if it breaks out here, we've got that distance here. If we got the breakouts here, we would have it at this level. So you have to wait for that breakout to occur. Now, you could technically measure the width, because the width will remain the same, and put it on your chart and continue just pulling it forward until you get a breakout. That would be perfectly fine. So right now, everything I say will be mirrored. Okay, if you have a breakout upward, it's the same as if you have a breakout downward, except it's the reverse. So when we get price to break out of this apex, no matter where it breaks out, it breaks above out of the triangle. The first thing we would do is we would set our stop loss. Okay. Now we haven't decided to trade, but we have to calculate all this out. We would be setting our stop loss a few pips below the swing low that occurred before the breakout. Not this swing low back here, and not this swing low back here, but the swing low, the lowest point it achieved right before the breakout. We would set our buy point at the close of the candle that broke out. This is the price in which we would consider buying. We're not ready to do anything yet. Okay. We would then set our target point at this point to this distance, which say would be here. We haven't done anything yet. We're not trading anything yet. Because what we don't have at this point is a confirmed breakout. Just because price breaks out of the triangle doesn't mean it's a confirmed breakout. It can go right back into the triangle. It could be a totally false breakout. It could be just a high. It could be a whole bunch of stuff. So the question is, how can we trade the triangle? So once we've got our point for our buy, our point for our stop loss, our point for our profit target, okay. Once the triangle is identified in the chart, traders will wait for a breakout either above the resistance trend line or below the support. After the breakout is confirmed, with either a closed candle above or below, a stop loss can be placed approximately 10 pips below the last swing low of that triangle. A limit equal to the height of the triangle can then be placed. But we can't make a trade. So here we would set our stop loss. Okay. Here we would set here's our breakout candle. Here is our entry point. and we need a confirmation. Okay. Without confirmation, we're not going to trade for 2 candles after we get the breakout. Because remember, I said to you, we want high probability trades. There will probably be a lot of trades we could have made, but they were iffy trades. We'll miss a lot of trades, but the trades we'll get will be highly successful. Okay. So again, we get our breakout candle. We can set our stop loss at the lowest swing low before the breakout. We can set our limit order based on the width of the triangle. Now, there's several things we have to do quickly at this point. First thing we have to do is we have to use where we'd have to place our stop loss and our limit place, and we also have our entry price to calculate our risk reward and our risk management tools to see that if we can even consider making this trade. We still, until we get a confirmation of the breakout, can't do anything, but we have a lot of little things that we have to do relatively quickly. Now remember, we would set our entry point, in this case we have a breakout down, at the close of the breakout candle. So let's go over, well, before I'm going to take you over to live charts to show you this in, when it occurs on a live chart. But then what we do is, okay, we've set our entry point. We have our breakout. We've set our stop loss. We have our profit target. Now, we have to wait for the second candle. And the only thing we're waiting about the second candle is that it does not return inside the triangle. And then when the third candle develops, the minute it touches that entry point that we had set from the first candle, we would then enter a trade. In this case, we would enter here, and we would have been able to trade this point going all the way down, because we would have set our target point around here, but we could have let it ride all the way to there. But we always need the breakout confirmations. And then we also have one last key we have to look at. The last key that we have to look at is volume. We have to make sure the volume is increasing to confirm that breakout. So let's go look at this on a live chart. So what we have here is we have a perfect candlestick formation, a perfect triangle formation. We have the breakout candle. So here we had a false breakout, here we had a false, then we got a breakout here. We then had the break and the confirmation here. Here we have the perfect descending triangle. But again, remember we said we're not going to use the words descending or ascending. We have a breakout down. And this is a very clear one to see. We have the breakout candle coming down, and this is a live chart. We have the confirmation candle here, and we would have entered a trade on this candle as soon as it reached the close of this breakout candle. We would have wanted to see a little jump in volume, and we would have set our stop loss here, here actually, and our take profit point down here, equal distance of the base of the triangle. Now there's one last key. We have to look at where the closest major support or resistance line is, because we cannot assess the limit just based on the width of the triangle, because it's going to get stopped at a support or resistance depending on which direction our trade is going to go. This would be a resistance line, and we need to then recalculate our limit and our stop loss to make sure that this will be within our risk management facility. And this is how we would calculate using a triangle. Now, we talked about earlier about the bullish and the bearish characteristic of these patterns. So we went back and back tested it. And we went back over 565 different triangles. And then we went through those that were supposed to have a bearish bias and those that are supposed to have a bullish bias to see how correct or how effective that bias would make our trading. We found out on a 4-hour chart, we only had a 54% bias. That's not enough to risk my money on. Bullish, we only had a 54%, 0.7% bias. When we jumped up to a 1-hour chart, we fell down to 51%. Well, that's half right, half wrong. So that bias is non-existent. So you should not clutter up your mind using that piece of information. But when we forget the bias and just trade the breakout with the rules that I set forth, using support and resistance, using volume, using the third candle confirmation, we'll miss a lot of trading opportunities, but we'll find that we moved to a 75% success ratio. I don't care how many trades I get as long as I get success, because the fact is the market gives us all the possible trades we could ever want. It's deciding which trades to take and which ones not to take. So what we want to do is continually move the odds in our favor. And remember, the last final trip of it is volume. Volume must support your decision. So it's 3 candles: breakout, confirmation, trade candle. Because there's always false breakouts, there's retests, there's everything. Or it's a breakout, but it isn't confirmed by volume and it doesn't have any momentum to carry it anywhere. So make sure you're always moving the odds in your favor. So the best way to trade this pattern is to treat it as a continuation breakout. Increasers says, while there are instances when symmetrical triangles mark important trend reversals, they more often mark a continuation of a current trend. Regardless of the nature of the pattern, continuation reversal, the direction of the next major move can only be determined after a valid breakout. So remember, we want to look at the trend to give us some confirmation. We want to look at volume. As we move to the apex, we should see volume diminishing, and then we should get the volume jump when we get the breakout or the confirmed breakout. This is called the quiet before the storm. And breakout direction, the future direction of breakout can only be determined after the break has occurred. Sounds obvious enough, but attempting to guess the direction of breakout can be dangerous. Even though a continuation pattern is supposed to break out in the direction of the long-term trend, this is not always the case. And as I showed you, less than 52% is the case. So breakout should be on a closing basis for it to be considered valid. The breakout should occur with an expansion of volume, especially on upside breakouts. After a breakout, either up or down, the apex can turn into future support or resistance. The price sometimes returns to the apex or support and resistance level around the breakout before resuming the direction of the breakout. And that's why we wait for the third candle confirmation. And there are 2 methods to estimate the extent of the move after the breakout. First is the widest distance of the symmetrical or the triangle can be measured and applied to the breakout. Second, a trend line can be drawn parallel to the pattern's trend line that slopes up or down in the direction of the break. The extension of this line will mark the potential breakout target. So to sum it up, triangle patterns are easy to spot and provide good risk reward opportunities. Traders can quickly know that a big move may be near, as well as the profit objective and the amount to be put at risk. Now that you have the knowledge of these three powerful price patterns, you are a step closer to becoming a confident trader. And like I said earlier, in the crypto market, technical analysis or chart analysis is all we have to depend on. Because when we take out all of the irrelevant economic data that affects all the other currencies and political headlines and central bank action, we're now down to becoming a technical trader and trading from price movements, price action, and having a plan, especially when trading the big cryptocurrencies. Because this doesn't work as well in the small ones because there's not enough volume. But keep in mind, if you're trading Bitcoin, you're trading Light, you're trading, Ethereum, you're trading Ripple. Okay, as long as they have some volume, all of these things should hold true. And if you're trading one crypto against another, doesn't matter. As long as you get the triangle pattern on the chart formation, then you're perfectly fine. So thank you very much for joining us. Thank you for being part of CoinLib. And if you have any questions, contact us online and we'll be glad to help you out. And remember, CoinLib is an information site. We're not there to offer trading. We don't sell coins. We don't buy coins. We are just an information media and support site. So come visit us all you want, because you're going to get the straight dope from us, because we have no other objective. So thank you very much and have a great trading day. Bye now.